Naveen, Unni. I'm a managing partner at TVS Capital Funds. TVS Capital is based in Chennai. We have also got an office in Bangalore. We've been around for about 19 years. We're about to enter our 20th. We've raised 4 funds so far, raised about 7,000 crores, all domestic capital. And therefore, this conversation is very close to my heart of where private markets are and domestic capital specifically. We're deploying out of our 4th fund, which is a 4,000 crore fund. We've deployed about 25%. We typically write mid-market checks, so growth equity checks, 300 to 600 crores. And essentially our mission is to empower next-gen entrepreneurs to build enduring businesses. So this conversation of private versus public is a very important discussion in that. And as we keep going, I'll share some more perspectives on that.
Thanks, Imran.
Thank you, Jinesh. Imran Jafar, managing partner at Gaja Capital. We think of ourselves as India's mid-market scale-up specialist. We started about 20 years ago, and we provide growth and buyout capital to India's mid-market companies. We invest in multiple sectors: education, financial services, consumer, and what we call intelligent software and automation. Very happy to be here.
Hi, everyone. Slightly odd one out on the panel here for 2 reasons. One, we are kind of slightly new kids on the block. Just started off 2 years back, and we represent a debt fund. So I'm Ashish Gala, one of the co-founders and managing partner at VentureSoul Partners. It's a debt fund that we started 2 years back with the aim to provide high-yield debt, venture debt, structured debt, to new economy companies, and try to bring differentiated solutions in that. Happy to advise. Sitting today, we've had now 27 companies in our portfolio that we have lent to, and some of them creating, real value. Some of them are there on the panel earlier and later today. 2 offices for us, Mumbai and Bangalore, where we run out of, and idea being, can we essentially provide smarter, more structured debt solutions and bring debt as a flavor into the capital, into the startup ecosystem.
Hi everyone, this is Anurag Agrawal. I'm partner with Aavishkaar Capital. Aavishkaar is known as one of the global pioneers in the impact investing space. We've been around for about 25 years, currently investing out of our 8th India-focused equity fund. We manage close to about 4,000 crores across these funds. Focus is on investing in companies that are solving some core problems, hard to solve problems, and generate impact on the ground, and at the same time create, generate financially benchmark returns as well. So we've invested in a wide variety of sectors, including financial inclusion, agri, affordable health, education, clean energy, waste, water, sanitation. So reasonably sector agnostic, but impact is at the core of whatever we do.
Hi everyone, this is Saravanan. I represent Premji Invest. This is the investment arm of Premji Foundation, to which Mr. Premji has donated all his wealth to. We are probably one of the largest domestic fund, which is kind of like carved out of foundation in order to keep the capital required for foundation and philanthropic activities perpetual. So we manage roughly about $16 billion across India and US, private and public market. So we kind of like are present across stages and across sectors, but 4 key sectors that we focus are financial services, consumer, industrials, and healthcare. But given the kind of capital that we draw, we don't manage third-party capital. It's all in-house single LP kind of a structure. We have a little longer horizon than a usual PE fund will kind of like operate. That gives us a lot more advantage in terms of incubating to taking bets all the way up to close to IPO. So that's broadly our strategy. I had a particular areas. Financial services is one of the core themes that I kind of like to look at. Happy to chat and look forward for the session.
Thanks.
Yeah, thank you so much, Jinesh. So my background, I'd been investing for about 16 years before starting Elevate Venture Partners 3 years back. Probably a fraction of AUM that all my other co-panelists manage. Fund 1 for us was 160 million, largely growth stage investments. Series B, Series C, look to invest in 3 broad sectors: consumer, financial services, fintech, and emerging areas, including EV, deep tech, and so on. Check size is anywhere between 10 to 15 million, along with our LPs in some of the recent transactions, including Porter, Full Life. We've invested about 35 million. So that's what we do for a living.
Hi everyone, I'm Abhishek. I represent Quadria Capital. We are a healthcare-focused private equity fund. Invest across India, Southeast Asia, Middle East, manage about $4.5 billion in assets, which makes us one of the largest healthcare dedicated funds in this part of the world. Typical check sizes for us is upward of $50-60 million. Invest in healthcare, but healthcare broadly across everything: hospitals, pharma, medtech, associated, which is a catch-all for anything under health, wellness, consumer care as well. Thank you for having me here.
Thanks, everyone. Right. I mean, just a background, I run Omnivore, which is a food and agri fund, and we focus on making investment in agriculture, rural India, and the climate ecosystem. Going back to the topic, I mean, look, I think we all GPs on this dais, right? So valuations are very core to our life, right? Whether we like it or not, that's the only thing we discuss in our life. Maybe I'm going to ask a question. I'm not going to ask everyone to give a response, otherwise I really cannot manage. I'm going to pick up names and say, how do public markets valuations differ from private market valuations? And what is really preferable at what point? Maybe I'll start with, Naveen, to you, to first question about it. Maybe then Imran can add, and maybe Quadria at the domestic capital can talk about it. So, yeah.
So let's start with that first question. There are two parts, right? So the public versus private market valuations.
VCs only ask one question. We can have sub-questions.
I'm sure there'll be like A, B, C and all. So let's start with just one question and answer that. Look, public market versus private market has been always a big question, right? And this is what we think about all the time, where you enter, where this thing can go. I think the first thing, at least from a private market standpoint and where we sit in the mid-market, is we take a 15-year view to life. Because 7 to 8 years is what we potentially can hold this asset. The next investor coming in, whether it's public or private, has to hold the asset for another 7 to 8 years. That's their lens, right? So we take a 15-year view to life. And in a 15-year view to life, valuations kind of regress to the mean. That's what we believe. You take public market valuations in India, we're now at about 21x PE, which is the 10-year, give or take, that's where the market is at. It's much above most other markets, but 21 is where it's been, let's say 10 years. So let's say that's what it should hold. And what that's meant is that from that high of 25, 26, which it was 2-3 years ago, it's come back down. But when something like that happens, it really impacts the private market much more deeply, as we have all seen. Like deployments, exits, everything kind of goes down, right? So in general, our view is take the long-term kind of where things go. And what happens sometimes when you find pockets of what we call overheating, we don't want to bite, right? So you take markets, I'll just give you an example, like precision manufacturing right now. You look at all the public, they're all upwards of 100 PE here. And they shouldn't be there. That's our view. What we think is fair is when it comes to about 15 to 20, and that for us is high, the higher side, right? Early double digit is where it should be in a long-term view. So that's kind of our lens to all this, and therefore, oftentimes we just sit on our hands, very tightly on our hands, especially when things just get overheated, and wait for things to come back. That's one. The second, I would say on the public versus private markets, at the end of the day, every sector has a certain cash flow and a cash flow behavior. Understanding where that is and what return to that should be is the most important thing in our business. So we are very, very, I would say, thoughtful and careful about that. Having said that, when corrections like this happen, is a great time for us. So in a sense, this is probably the best time for this panel when that kind of 25 to 21 correction happens in the public market carries through into the private market, probably the best time there is.
So this is where we spend our entire lives, right? I think having your ear very close to public markets is a great advantage if you're a private market investor, because if you solve for some of the vintages of froth in public markets, by and large, public markets care about only two things. They care about earnings per share growth and return on equity. everything ultimately gets distilled into these two metrics. And that's a great framework to have when you're investing in private markets. And sometimes you have to use some imagination. I used to describe a business as buying revenue and selling EBITDA, partly because the companies that we invest in don't have EBITDA, so you're forced to look up. And sometimes, in tough markets like now, you buy EBITDA and sell earnings. But having 1 year at the discipline and collective wisdom of long-term public markets is the point I'm making, is actually a great framework to test your valuation frameworks, even at the earlier stages. We come in, of course, at the growth stage. And then what you do is, you use guardrails. So for example, there are, consumer tech companies, which earlier used to be GMV focused, etc. And you can't just apply a revenue multiple without thinking about the unit economics and how robust that is. Naveen, you made the point of TAM, is this business, does it have a future, not just in your investment horizon, but 2 to 3 times that? How large is the market? How innovative is the business model, and so on? But those are nuances. I think the nature of this is that ultimately EPS growth and ROE matters.
Abhishek, do you want to give?
No, so I think my co-panelists have answered quite a bit of it, but I think where we sit in a little bit late stage where a lot of our competition is not just private market, it's public market. So in a lot of our conversation, when companies come to us, we say biggest competitor is not another private equity fund, it's more public markets because those companies have scaled, they can go to public markets. From a valuation standpoint, one thing which the public market investors have an advantage is liquidity. We need to solve for that. If you come in as a private market investor, the stock is illiquid, there needs to be some protection, there needs to be, we need to be cognizant of how the markets may behave from an exit standpoint. Having said that, at least what we've been seeing over the last couple of years, taking some of our assets to the public market each year, even the public market investors are getting more and more disciplined, especially at entry, right? They want some cushion, they want predictability. A lot of times, and coming from a healthcare standpoint, a lot of times earlier it used to be possibilities. Now people are looking at predictabilities. They're saying how predictable it is. If a business is predictable, then yes, the gap between private and public starts to become extremely large. Public markets start to reward some of those businesses where it starts to get at, multiples where we can't even think of. So it's a lot more, as you think of where it is about being disciplined. Private market are a little bit more disciplined because of illiquidity, because of the risk you can't sort of, take an exit and move on. So some of that comes in. And from a business standpoint, it depends where you are in the cycle of what is the better capital for you, given each capital has a, positive and negative.
Cool. I think it shows that while investors' life from outside looks glamorous, it's painful from inside. So that's the broad understanding I have it. I'm going to ask the next question, right? We talk of private capital, versus public capital, right? I also want to talk about domestic capital versus the international capital. Because Indian ecosystem has both the genres of capital coming in. So, what's the value addition which the domestic capital does over the international capital or vice versa? Maybe we can start from Navin from Elevate and then we can go the remaining 3 people after that.
The question is, what is the value domestic capital has over international?
There are 2 kinds of capital, domestic and international. What value it does to the Indian ecosystem, startup ecosystem, and what's preferable where,
Okay, this is a very odd time to ask this question because none of us would even have the courage to show up in front of any dollar capital investor at this point of time.
We all do.
The first question you get asked for, whatever, rupee was 84, now it's 94, right? How do you do that? How do you look at the 12% currency depreciation? But I think it's a smaller aspect. I think, in my opinion, long term will be a little okay. I know slightly digressing from this question, but when I was in Singapore recently, but I just ended up doing some math. We were at about, in 2005, lowest was 43, highest was 46. So let's say average 44, 45, and from there 94. Even today, it's assumed, let's say 2.1, 2.2x over 21 years. It is 3% depreciation. So sometimes it is not as bad as people make it. I think, yes, no doubt, this year has been a significant aberration with close to 12% depreciation. I think the biggest question troubling global investors is the rupee depreciation at this point of time. That's one. Second, I think even in terms of long-term focus, very, very differentiated focus that each one looks like. International capital is more focused, for example, on MOIC. They are okay with a longer holding period and their preference would be a minimum 5 to 6 year holding period, average holding period of all the assets put together. So even if you do 18-20% IRR, you'll end up with a higher MOIC versus an Indian investor who would constantly want the churn of capital. Third, I think thanks to what's happened, and you look at firms like Naveen's firms, right? TVS raising 4,000 crore domestically, Motilal raising 5,000 crores in 3 months domestically, 6,000 crore, all from family office. So huge, significant sort of capital available domestically, where I just feel that there is no reason to go outside to raise money. You get a good set of family offices and maybe some institutional investors in India. You can build a fund with like a 5 to 6 year horizon period of average holding period. And second, like personally what I have seen, significant help in deal flow. The kind of deal flow that I get from my LPs, family offices is much better. Of course, it's expected to be much better than what I get from institutional investors. So I think from the GPs that I speak to, there is significant need of preference of raising Indian money versus institutional money. Yes, there will be a charm of institutional money with US endowment funds, Hong Kong, Singapore fund of funds. But I think domestic private capital with families and institutions in India is starting to get even more deep. So hopefully this will continue to exist over a period of time.
Thanks. And maybe Saravanan, if you want to add about it.
From the perspective of promoters and founders, right, that kind of like also matters a lot in terms of how they are raising capital across different cycle. Because sometimes the FDI and the global capital inflow changes, whether it is private or public. I'm just kind of like starting off with a little generic view. It oscillates substantially depending on the global kind of like shocks or optimism, right? And hence creating that surplus or a buffer with the domestic capital is always good, and it has been happening over the last 8-10 years. Even in the public market, you see the roles that are being played by the domestic funds, right? And we perhaps manage nearly about $5.5-6 billion all domestic capital in the public side also. And on the private side also, particularly in the regulated space, right? Whether it is regulated like in the financial services, payments and other areas, or in sensitive sectors like space, robotics, defense, healthcare even, right? So in some of those areas, it matters how the cap table is kind of like built. And in those areas also, the domestic cap table plays a big role, both from driving certain outcome and scale using the domestic capital only with a reasonably managed comfort level on the cap table on who runs and how the residential ownership kind of like stays within the company. From that perspective also, it matters a lot, and it gives a lot more comfort even from the regulatory point of view and from government point of view to let some kind of a sectors flourish. Right? I think there is a definite edge in terms of bringing that domestic capital, right? And just one point I want to add on the risk return perspective also, right? And you did mention in the previous question also in terms of private and public. I think with the domestic capital, people can kind of like balance the risk return, whether they are taking on the private side and the public side fairly reasonably, right? Whether it is dollar appreciation or depreciation that you kind of like call, or whether it is how much of alpha that you are generating for a country risk, right? The return expectation becomes dramatically different between a global capital and Indian capital, right? So from that perspective also, it will be reasonable to kind of like manage the risk return expectations. I have one interesting data point, right? In US, the enterprise value derived from the terminal value has shot up to 85-90%. And in India, that number is hovering between 50 to 55%. That means that in the listed universe also, people are a lot more sensible in terms of how much is cash flow important versus how much is some futuristic cash flow projection important. But it has dramatically shifted, in the US, and might be it will happen in India also. But today, that kind of a private and public market balance, that is the point that you raised earlier, sits there also. How much of stability that has been established in the cash flow determines when to access the market and who to accept and how to accept that, whether it is mix of domestic or foreign, can probably drive a long-term stability for a company in this space.
I mean, I agree with you, right? But one point is like domestic capital per se is very short-term approach. For them, 6 years, 7 years is a long-term. When you talk to international capital, 15 years is fine. So that's where we have to look. When you're looking at a country like India, you want result in 5 years, I don't know how much you can get, right? Nothing happened before. I mean, I agree with Naveen, it's a 15-year horizon to do that. I don't know which domestic capital has the appetite. I mean, I don't see up till now. But going back to Anurag, what's your thought on the same here?
Yeah, so I can share, we've been raising capital for 25 years now, and there's been a very dramatic shift in terms of the kind of capital that we've been able to raise, right? So initial years, almost 95% of the capital that we got for our funds came from outside India, and only about 5-10% came from within India. That has shifted quite dramatically. In our last 2 funds, we've got roughly 50% of the capital from within India. So for this asset class of impact investing, capital simply was not available. I mean, it was a new sector as well. And a lot of it was mandate driven, right? I think the points that are made are quite valid with respect to the moment you raise, international capital, the exchange currency rate comes into picture, which is not there in the case of domestic capital. Also, the time horizon point is also very valid. Typically, the expectation or the patience with the capital is longer with the international guys versus the domestic guys, who typically are looking for shorter duration. Also, in terms of, just because they are domestic and closer to the ground, possibly, they are more aware of what is going on here and, have the ability to get hands-on. Also more keen on co-investments. So these are some of the nuances that we see, differences between international and domestic capital.
Ashish, you're raising a debt capital. Would just love to get your perspective, because you would have seen equity or co-equity investors debating whether it's equity, domestic or international. I mean.
Yeah. No, so I'll add, and my fellow panelists have added on the equity side, so I'll add a flavor from the debt perspective. See, one thing we see this is, whether domestic or international, right? I mean, maybe they are complementary pockets of capital, not competing, right? And I think we need both of them to be available at different points in time for solving, different situations, but also bringing more, I would say, vibrancy into the overall system. Specifically from a debt perspective, right? The way we see it is 2 very different set of pools of capital within the debt that's available. The domestic debt guys, they basically take the first leap. They are the pillars who kind of understand the companies, the sectors, they have the feel on the ground. And they set the base for the company to have that borrowing kind of validated, right? And they serve that purpose. Having said that, and we are a domestic fund, but when we look at our international players, the thing that they bring is kind of quite interesting, right? I mean, I would rather call out 3 things that international debt capital brings, which is not available. One is clearly the size. I mean, for all said and done, the Indian debt market is still not that deep and vibrant. I mean, even in the startup ecosystem, we say, the overall debt capital is like 6 to 8% of the cap table versus easily 15 to 18% in, place like US, right? And when the international player comes, they kind of come in with size. Second, rightly or wrongly, right? I mean, we are all probably so tuned to it, there's a stamp of validation. The moment a company gets a large international capital done, it's a stamp on validation that we all see. And importantly, probably that comes about to the third point, which you also touched upon, was the tenor, right? I mean, validity. I mean, again, when we look at from debt perspective, Indian debt players probably give at best 2 years, 3 years, right? Maybe stretching up to 5 years in certain cases. We've had one of our portfolio companies that has raised a 7-year bullet debt financing, right, in ECB. You don't see that happening from an Indian player's perspective, because the capital that we raise at the back of it from Indian LPs isn't available for that time horizon. So I think we see both of them quite complementary in terms of what international player brings. And I'll just add one additional point. As Indian startups and Indian companies venture overseas and they need to set up their footprint there, it's important they have access to the international capital available in those markets. So it's not just about the international capital coming into India, but international capital available to Indian companies as they venture overseas. And that, I think, plays a very important role. So,
in investing, basically, you are trying to balance three things, right? Risk, return, and liquidity, right? So ultimately, any investment opportunity that you're looking at, you are trying to see, again, you take a long-term view because not only you're holding this asset for a long time, but you need to sell it to somebody who will then hold it. So, they will take that into consideration. So, we are typically not guys who invest in infra per se, but anything that we invest in, we see, how large the market is, where will it be when we are likely to exit that company, and on that basis, you see, where will this company, typically we are early to early growth stage kind of investing, right? So your traditional metrics of PE multiples, etc., don't apply because sometimes the PE or the EBITDA is not there only, right? So you are, like one of the panelists mentioned, you're investing at revenue multiples and exiting at the time when you're exiting, you're looking at EBITDA, right? So you have to look very closely at what is the unit economics, what's the scale this company will reach, can it get to profitability, what level of profitability, and you'll have to underwrite that. So that's how we typically evaluate our proposals.
I think Anurag articulated it excellently. Just like what a global sovereign funds like ADIA or other big guys are trying to do, right? We are kind of like trying to form a very similar model, right? See, for us, we are holding NSC like an asset for 20 years. It has given us a 40x outcome, right? No hurry to exit in anything, right? But once you institutionalize this in the memory of the, any kind of financial institution, you can create different strategies, right? Now we have an early stage strategy where the aggression part or a high risk part, what we are kind of like taking, we can do. We have a traditional growth strategy. Then we have a buyout and a platform strategy. And the new class of investments where, again, the point that Anurag mentioned, risk, return, and liquidity goes hand in hand, right? If you're going in the infrastructure kind of an asset classes, we have to be very cognizant that with leverage also it will be in the mid-teen kind of a return, right? And you have to have a 8 to 10 year longer hold and drive on the cash flow. Provided there's a clear understanding on what we are kind of like solving for, it is easier to kind of like get into the skin of the opportunity and play around. This is a new strategy that we are getting in. But again, to your point, as long as people understand the risk return liquidity equation and have flexibility to play around each of these by tenor also and by the expectations around these three also, people can kind of like create structure. At least from our point of view, that is how we are seeing and trying to build different strategies with different risk pool and capital internally.
Cool. Yeah, I'm going to ask one more question. Then we could have. It's always interesting to see. We all talk about valuations getting rationalized, right? So I'm going to start with Abhishek. Do you see the private markets becoming more disciplined than before? And do you see any impact on the entrepreneurs?
I think private markets were always disciplined. It is. I think they're getting. It's more contrary because of the capital that most funds have raised and the competition that they face with public market. There is some sense of irrationality that we start seeing in pockets. But by nature, they've been more, in fact, the other way around. Public markets are, like I was saying earlier, they're getting more disciplined, at least at the start. Private, it's also depending on quality of assets. A lot of times what we do is, we say private market median is X, but the problem is that in the private space, whether it's a small asset, whether it's a large asset, the quality spectrum is very, very large as compared to a public market. And hence, there's not a one-fit-all strategy when you think of private market valuation and you start, benchmarking it to public markets, because probably the public markets are the number of assets, the assets are operating at a particular quality. The private market scale, quality, some of those factors are very different, and hence you need to have a very large spectrum when you think of valuation on the private market side.
Anyone wants to add? Then I'm going to make a follow-on question.
See, I agree that private markets have been disciplined, but there's always a bubble in some part of the market, right? So in 2021, there was mania in anything tech, frankly, in private markets, and more recently, anything that has a prospect of going public is in kind of bubble territory. So you have to be selective, but by and large, if you look at let's say the last 5 years as a cycle in private markets, we've gone from mania to funding winter to resilience to discipline. So I think relatively speaking, in a 5-year time frame, you can say that we are far more disciplined today. But I just say that there are pockets of exuberance at every vintage. I haven't seen a completely exuberant market outside 21 or a complete funding winter yet.
Maybe Naveen, I'm going to go to your last question, and then maybe someone wants to add. When is the right time to go public?
Again, I'll tell you the way we think about it, because we have this conversation a lot, okay, with founders. Because we are in that mid-market, and eventually you go and meet them, as I'm sure other people in this, and they'll say, look, in 2 years, 3 years, we'll go public. And I'll often ask them, why? Why do you want to go public? And they'll say some things, right? And sometimes they'll talk about it's the right step for us to do. We want to be a forever business. This is how we do it. And sometimes it'll be about status. And you'd be surprised at how often it is about a marker of something. We have arrived. And you can feel it. As an entrepreneur, you have gone through so much pain. And there are entrepreneurs in this room. You feel it, right? It's a validation, a really public validation of where we have got to, and fully understand. But the public market is super unforgiving. The quarterly cycle is relentless. It isn't like, the thing is, it's a bit like you get somewhere and you've worked really hard to get somewhere and you realize it's day one of the next thing and you're not sure you want to do that, So I often I get into what does it mean to be public? Do you understand that? Do you understand the compliance burden? Do you understand that sometimes you're going public but you don't get liquidity? You're like a small cap that will just swing as things go. So a lot of times for us, this question of, are you ready? And what does readiness mean is the conversation we want to have. So it's a question of, are you at the right scale? It's a question of, do you have the right business model and is it reflecting in business economics? Like Imran said, you look at revenue and then you exit at EBITDA. We look at EBITDA and exit at earnings, right? So when you do exit at earnings, what does it look like? Is it something that the market will respect? And then you don't want to be in the middle of transitions because the market doesn't fully understand transitions. You're Elon Musk, anything goes. But everybody else, you got to show cash, and you got to show cash for a few years. So that's the conversation we want to have. We want them to be in a really great place, and sometimes for that patient capital that can work through the winds, that can work through the ups and downs, and can help them set up the right governance, set up an enduring business is right. And that's the conversation we want to have with them.
Anyone else wants to add here? Yeah, please.
I think there's a predictability and boring quotient, right? A company should become as boring and predictable in terms of whether it is cash flow, revenue, EBITDA, quarter-on-quarter growth and year-on-year growth. Once they reach that stage and they are big enough to be kind of like getting good investor interest across mid-cap, small-cap and large-cap mutual funds and global guys, that's the time they should even seriously start thinking about. I'm wondering how deep even Indian, listed universe is. US is very deep, right? You can have 20 similar-looking companies. If you are a third similar-looking company today, you are getting 30% discount to a leader, right? Do you really want to get into that for vanity or whatever reason, right? I think some of those things people should really think. Consolidation, M&A is a big opportunity which still people are not exploring today. Once you consolidate and list as a big player, you might probably command superior kind of a value also. I think one should take objectively a look at all these options before kind of like jumping into a public market. As Naveen pointed out, we also very closely work with the founders and figuring out right strategies for jumping from private to public before getting compelled by many other factors.
Thanks, that's it from my side. But thank you, panelists, for trying to work and answer all the questions. It was great talking to everyone.